We will be diving into interest rates, how that affects the mortgage payment, who controls it, what are the factors that influence it, and also diving into a couple scenarios for when you are buying a home and how those will actually impact your mortgage. If you find any of this content helpful, it would be wonderful if you could be interested in hitting that like and subscribe button. My name is William Singh. I'm a local real estate agent here in Portland, Oregon, and we'll be diving right into what is an interest rate. A mortgage rate is a rate of interest charged on a mortgage. Mortgage rates are determined by the lender and can either be fixed, staying the same for the term of the mortgage, or variable, fluctuating with a benchmark interest rate. Mortgage rates vary for borrowers based off of their credit. The lower the interest rates, the lower your mortgage payment will be. The higher the interest rate is, the higher your mortgage payment will be. So when it comes to looking at this, a general rule of thumb is for every 1% increase in the mortgage rate, there's going to be a 10% decrease in your buying power. And the reverse is true. So if the interest rate goes down by 1%, your buying power increases by 10%. So for example, if you were to have a pre-approval at $400,000 and the interest rates decrease by 1%, then you'd then be able to afford a home at that 440 range. Keep this in mind when you're looking at interest rates and seeing what will work best for you. Again, a common thing that I want to make sure you're aware of is to not over leverage yourself. You want to make sure that you're not going to be house poor, and you can make sure that you can afford that and have months of reserve in your bank account, so that way if anything does go wrong, you have something to fall back on. Rates are primarily based off of the bond market. The Federal Reserve, aka the Fed, has a large influence over this, and they can either increase rates or decrease rates, and then the bond market will be affected by this. Just know that there's other things that will affect the bond market in terms of world events and other external factors that will play into the bond market, but know that the primary driver for increasing or decreasing rates is going to be the Federal Reserve. So when they're saying they're hiking rates up, know that they'll probably have a corresponding response in the bond market that will then push rates up. The reason why the Fed usually will be increasing those rates is to reduce inflation. So in order to reduce inflation, they increase those rates, which makes it harder to lend and makes people spend less money, thus decreasing inflation. All right, so we're going to be taking a look at a couple different scenarios. That way you can have a better understanding of what happens when the interest rate increases or decreases. So that way, when you're looking at these numbers, you can put this in a calculator and you understand a little bit more of the relationship between the interest rate and the mortgage payment. Note, in this, we are only going over what the mortgage payment is and not what the taxes and insurance are. So make sure that you add those in later on if you are starting to calculate and trying to understand this a little bit more. So with that, our first scenario is going to be a $350,000 purchase with a 3.5% down, which is about $1,200. And at this 3%, we have a mortgage payment of about $1,400. And as you go up, you're going to notice that in average, it'll be around $200 to $220 difference for each percentage up. So that really starts limiting you in terms of your monthly payment and can quickly spiral in the sense that you might have been able to afford a $1 million home, but if you had a couple more points that would go up in terms of the percentage, your ability to buy that home might drastically change. And as you start having higher interest rates, the total interest that you would pay off for the lifetime of the loan will start to increase as well. So, for example, if we're at this 7% interest rate, then with this $350,000 loan, you are then also paying over the lifetime of the loan more than what the loan amount is or what you purchased it for. So keep this in mind as you're doing this, but just also know that you will have appreciation factor into this when you're buying homes and you're looking at a longer term. So when you're looking at the next scenario, which is $500,000 with 5% down, that's about $25,000 down. We're looking closer at this percentage jump, and you're going to notice that it's going to have a little bit more significant jump at that. So the higher the purchase price, the higher the jump is going to be between each percentage point. And again, one of those things where when you start getting closer to each percentage jump, you're going to see a larger amount of interest you'll be paying over the lifetime of the loan. Note that you can refinance, but just make sure that the term, i.e. the length of the loan, doesn't change much from the initial date. So for example, when you are buying a home, it's usually going to be on a 30-year mortgage. Off of that 30-year mortgage, if you were to refinance, let's say in the following year, that then pushes out the date for the loan term. So if you're trying to just lower the interest rate and then focus a little bit more on paying off the interest a little bit faster, try to get the loan term to be about the same time. Now, diving into the $800,000 with a 20% down, which is about $160,000 down, you'll notice again there's going to be a large jump when it comes to the percentages. So this might be a $400 a month difference. And again, you're going to see as the interest rate increases, you're going to be paying more and more in the total interest. This is going to be good to know. So that way, when you start looking at refinancing, you'll know, hey, when would be a good time for you to refinance? I highly recommend you talk to a lender to see when it would be a good time for you to refinance. And I have a different video that goes over that as well. I hope you found this content helpful. And if you're interested, hit that like button and subscribe to help support the channel. If you have any questions or want to talk with me, feel free to reach out. I have my contact information down below. And if you need to get connected with a lender, feel free to do that as well and reach out to me and I can give you some great suggestions. Thank you so much for watching.